should you invest in property or index funds? And what's the opportunity cost of choosing one versus the other? Hi, I'm Jaryd Krause.
I'm Sam Powell, and we're the hosts of Property Pals Australia podcast. And in this episode, we're going the pros and cons of each. We're discussing, using leverage both with margin loans and with property, and what performance to expect too. We look at the annualized performance over the last 5 years for index funds, and then what property's done as well. And then we also extrapolate that out to a 30-year period for both to try and help people understand the pros and cons to each. And there's a definitive answer as to which is the path to go down towards the back end of the podcast, isn't there, Jaryd?
Yeah, and it's not just like we are biased towards property to a certain extent, but we both have bought, index funds and stocks, and advocates for it as well. And there's a way that you can do it both of them in unison that can be beneficial when you understand the risks of both, using leverage for both and or not, and the opportunity cost. So there's so much value in this pod. It was a great one actually to just riff on, Sam. So I appreciate your time. And guys, if you want more help from us for free, we have our How to Maximize Your Borrowing Capacity mini course. Can help you buy superior assets by getting more leverage. So get that at propertypals.au. But yeah, let's dive in. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Morning, Sam. End of 2024, coming into 2025. How are we feeling?
Feeling good. This time of year, with every podcast and everyone's coming out there with their predictions for 2025. Jaryd and I discussed this just quickly, and we thought, what a pretty boring topic to talk about. So we're not going to be talking about that today, because I can summarize it in one paragraph. 2025, supply, demand and balance still in place. Elections out of the way with the US. Confidence is coming back to the market. Interest rates are dropping in Australia. So I'm expecting bullish price growth in the majority of locations throughout Australia. There's areas that are going to outperform, and that's why, you go and seek those experts to do it every day to help you outperform markets. That's pretty much what you're going to hear everywhere. We want to talk about something a little bit more interesting, don't we, Jaryd?
Far more juicy. Yeah, you can have the standard Australia's property market's going to have a growth rate of 5%, 5.6% up from 5.3% in 2024. But I mean, who really cares when we're not buying in the whole market of Australia? We're buying in one little small market, right?
Buying a house or a unit within a street, within a suburb, within a local government area, within Australia.
Yeah, exactly. So that data is not really going to help you. So we just don't think it's very valuable. But one thing, the juicy topic that I think is worth chatting about is index funds versus investing in property. And I've had this conversation with two friends now, and many other people that I'm not so close with around why not index funds over property when index funds have outperformed property. So we'll stick. I think what's the best way to explain this is have an example of how much you have to invest in either. And then be conservative with the growth rate of both. So my friend, he's like, all right, well, so how do we start? So let's say we've got 100K to invest, right? The equation to really work out is just opportunity costs. So it can be quite simple. So if we've got 100K to start off with investing in the stock market, let's just say a mutual fund, an index fund, say like Vanguard. And what does Vanguard get? Roughly 8-ish% a year conservatively growth rate?
this, we go rewind a little bit. Like index funds outperforms property. Such a broad statement. Let's, you need to dig a little bit deeper into, well, which index funds are you tracking? To do that, I've just jumped on the Fidelity Zero Large Cap Index, which it's basically, an array of different, stocks that are within that. Their performance 5 years annualized return is 15.7%. The S&P 500 ETF with Vanguard 5-year annualized return is 15.6%. So they're pretty good returns. Like you generally want to be trying to get with stocks around that 10% plus as an average basis. So it's not too bad. But
also, I mean, let's we've got to realize that there's 4 years of COVID then.
That's what I was going to say.
Right. And what's the average over the last 30 years then? Have we got that data?
Come on, mate. You're probably sitting around that. Probably with these ETFs. I'm pulling a figure out of my backside, but 10% was sort of like I know the S&P 100, and a lot of when I was back in my financial planning days, the financial planners used to track the S&P 100 or 200, and the goal was to outperform, and that generally sat around 10% from a performance basis, which is still a good return because, as we know, there's that rule of 72, which if it's growing at 7.2% each year on year for 10 years, you're doubling your money. That's a really great result.
Yeah, absolutely. Absolutely. The reason we need to mention that is because if we're going to go from the average growth rate of index funds for the last 5 years, we need to do that with property as well. And I just don't think it's a long enough time frame, especially with property. We've gotten COVID in that time frame when property prices went crazy. And then I think being a property podcast, people are going to have the illusion that we're going to be more biased towards property. But if we did this, property would clearly just smoke business on index funds. So,
I just did a quick little search, and the last 30 years, the S&P 500, the average return is 9.9%. There you go.
Yeah. So let's say 10%. Okay. And with property, we're getting what? If we're going to be conservative in Australia, would we say 5% or maybe even 6%?
Yeah, I'd say conservative 5. Like the 30-year average sits like around that 5 to 6% range. So that's really good.
Cool.
Well, I can do better, but
I know you can from personal experience and all of the clients and the people that we've helped. So far superior. I would say conservatively, you'd get a 7, 8%. That's very conservatively.
My goal is in the first year, right? Like it depends where you buy, whether it's a warm spot or a hot spot, and I'm aiming for 7.2%. That's my goal with property, because the beautiful thing about property is like you hear the percentages, and this is for people to really understand too. Is stop taking things on a comment or a face value, or reading one blog post or listening to one podcast or whatever. Like, do the hard work, because it's gonna help you figure it out a little bit faster. In my opinion, anyway.
Exactly.
With property comes leverage. Yes, you can leverage with margin loans into shares, and that's a good strategy as well. There's more risk, and because it's more volatile market, you're subject to margin calls. And what a margin call is essentially your funds drop, like you've got a loan essentially. So if your funds are dropping below a certain threshold, they margin call you. So they put their hand out and say, you need to top your funds back up to a certain level. Otherwise, we're going to have to sell these assets because you've become too high a risk, because the loan involved here is getting close to the overall value of the portfolio. If it drops any more, then we're going to be in debt. You're going to be in debt to us, and we can't have that.
Yeah. There's that as a very important factor, and then so many other factors as well. So I'm glad that you mentioned that. We don't need to explain the margin call any further. But I think if we come back to the 100K, we've got the 100K. If you go buy 100K worth of index funds, on average, this is probably not super conservative. I would say 8% conservatively, but let's just say 10%. Let's give them a bit of a leg up here. Say 10%. Sorry?
Round figures.
Round figures, yeah, exactly. Easier to understand. So 10%, 100K, 10 grand a year, compounding annual growth rate. Well, compounding annual growth on your money. If you go buy a 100K property for 100K with cash, which you would, you'd probably get, and being conservative, what you're going to get 5 grand for the 5%. Very conservative, the growth rate. Now, most people are never going to buy a 100K property with leverage, with just cash. So with that 100K, typically you'd be able to buy. Well, now you can buy a far superior asset with less than 100K. And we know people that have bought 500K properties with 50K recently because of 50K or less because of the incentives from the government, like homeowners grants. And so we're not going to put that into factor because yes, there's nuances all in both different scenarios. So say with 100K, you can buy a 500K property, sticking with round figures, right? So if you go buy a 500K property with round figures at 5% growth rate, what are you getting? 25 grand a year in capital growth?
Yeah, call that. It's 5%.
Yeah. So that's the beauty about property is you have using the leverage. You're going with that 100K in shares or index fund, I should say, is you've got a 10 grand versus 25 grand because you're able to use leverage. But what if you did use leverage with index funds or into shares? One thing about that is typically the interest rate is going to be significantly higher for that finance for index funds. Why? Because business is a lot more risky. So that'll make it less profitable for you and far more risky versus interest rate for and loan terms for a property. So with that, you could still do it, but you've got that added layer of risk. And I dare say you probably wouldn't be getting the same. Like, let's say you've got, I don't know what the terms are. It might be like a 10% interest rate versus like a.
It's generally 2 to 3% higher than what your standard mortgage rate is. So, say it's 6.5%. You'd be looking at around 8.5 to 9.5 for the margin loan. So a little bit more on that front. With the opportunity costs,
maybe you could do it. You could do it with index funds, but there's one other thing that maybe people aren't thinking about, which is risk, right? So with doing, you've got the margin call, you've got higher terms when you're using leverages for index funds. But when you compare business to property, business is so much more risky than property because in business, things can change a lot faster. And it's so much harder to get it right because people are more likely to stop spending money. And we saw this in COVID, right? People are more likely to stop spending money on consumerism products and services, but less likely to just pack up their house and leave when they have kids that go to school, their family lives around them. It's slow to make a transaction which is a positive for index funds. To make a transaction in index funds, you can get in and out really fast, and the fees are less, of course. Same with the opposite with property is it's slower to get in and out, a lot slower comparing to index funds, and the fees are more. However, if you did the 100K capital, the 100K opportunity cost over 10 years for property with leverage versus index funds with minimal to no leverage, you're really going to win in property, even with transaction costs in and out, right?
Yeah, look, the standard sort of loan to value ratios for margin loans, I think the maximum sits around 75%. So you can go up there, but the thing you need to understand as well is the emotional side of it. Like you and I, we've we trade. We don't trade shares. We invest as well, and we used to trade. I think when we were younger, and we sucked. Well, I sucked at it.
Wow,
Too
I do with
emotional,
fake
mate.
money. Yeah. Well, hey, who doesn't suck at it? Is like 99 point something stupid. Like 99% of people that are day traders fail, or something like maybe 97. So it's, and then you're competing with computers, really. Like now you're competing with AI that can, just get in and out real fast, can pick the tops and the bottoms and the trends. And you're like, as a human being, you just are not as sophisticated, unfortunately. So fool's game, I believe. That's my personal opinion.
Yeah, there's actually I know a few traders, and the comments are really like you're playing a game against people that are far more experienced, and also like they do it every single day, and they're on the computers for like 10 hours a day tracking charts. Like if you can't commit to that level and that's your full-time job, don't be a day trader. People leave their jobs thinking, oh, I don't have to work for someone else, but you're just going into a different job essentially. Yeah, you're working for yourself, but I guess going back to what we're talking, like with the margin loans on it too, it's a lot more volatile market, so your emotional roller coaster is a lot greater with that share when you're doing those margin loans with index funds as an example.
Yeah, exactly. My biggest thing is like the risk. When people are investing, I think we get clouded. Our judgment gets clouded by like how much money we can actually make and go for the most amount of money without. I mean, scary.
Yeah. Well, I'd say one thing with all that is when you're going into investing, you need to decide, and this is what I didn't do, right? Like I was just investing, and I just wanted to be in the market and learn it. And like you learn through failing a lot quicker than you learn through your successes. And you just got to understand your profile. I know it's not the exciting part, but taking that time to sit back and think, what kind of investor or trade, like what do you want to be? What does that actually entail? Because that's what helped me a lot. I came to realize that I'm not short term, I'm medium to long term, because it takes a lot of more of the emotion out, and I can play a zoom out, play a bigger game, and it's a lot more enjoyable in your day-to-day lives, because you can just get so caught up in like just tracking charts and analyzing businesses. And the reason why I'm telling you this is like, if you really, really enjoy that and you don't really like hanging out with your friends or your family or exercising, then go for it.
It's we don't need to go into that any further. I think it's worth explaining like the risk. Like if you want to make more money with less risk, it can be done through property versus index funds. And let me explain why. Say you've got 100K, and over a 10-year period, you put 100K into your index fund, right? And you're going to make 10 grand a year. And let's just say it's not compounding annual growth, just for the sake of the math on both sides, like property versus index funds. Let's just say you get 10 grand a year, and that's 10 grand a year over 10 years is 100 grand. So you can make 100 grand. Awesome. And it's not too risky because it's all cash. It's over a 10-year period. It's a longer investment cycle. Now, say you do that with property, and you have a conservative growth rate of 5% for a 500K property with a 100K deposit, and you get 25 grand in capital growth. So let's just say it's a neutrally geared property. You get 25 grand in capital growth over a 10-year period. That's 250 grand. So you're actually making 100. This is not considering entering to the index fund and exiting the index fund and then buying the property and then selling the cost of selling the property. You're going to get an extra $150,000. Now, let's say that you decide to enter into index funds for free and exit index funds for free, and then it cost you with property. The entry cost could be 20 grand, and then the entry cost could be maybe 10 grand, right? For example. So you got 30 grand. So you take 30 grand off the 250, or the 150, I should say, that you've made in profit. So you've got 120K extra over the index funds. it's quite clear that it wins with less risk over time.
Yeah, I'd go deeper to, like, I guess 5%. You're sort of running the conservative figures. Is I guess spoiler alert really is I believe in both.
Absolutely.
In that, but it's good to break it down. The positives of index funds is more liquid. Property sucks with liquidity, but that also helps you not. It takes your emotion out because you're just like, oh, you can't just sell it because you're emotionally elevated at that stage in your life. And yeah, there's definitely pros and cons to both. In regards to outperformance, it's really like, yeah, understanding like there's different properties, right? And that's the issue that people do face, is that there's properties that grow in value, and there's properties that kind of sit around and do not much, being high rise apartments in regards to that value. But also index funds, like what kind of index funds are you investing in? Like there's global, there's national, there's going into commodities, there's going into like innovation technology. Like I've got a couple in like genome sort of technology, thinking that's something rampant that's going to evolve, but it sucked over the last couple of years. But it like had a thesis, and it was a 10-year time frame to reassess. So
I also think like it's so much harder to get stock picks right versus property. Like it's like, again, coming back to the risk. You can, like, the equivalent to a buyer's agent in, say, index funds or stocks is like maybe somebody who's like a world-class investor and you pay for their advice, but then you have to have a lot of trust in them, which same with a buyer's agent as well.
They're a fund manager.
Yeah, you have a fund manager for sure. With the, like you said, with the spoiler alert, like doing both, like I think there's a strategy to use both in unison, and to start with one versus the other. So, for example, what I've actually shared with people is like if I was starting from scratch, and what one of my friends does, and other people that I've sort of shared with that they could possibly do as an example is, if you don't have the money for a deposit yet, work your way up to that 80K or that 70 to 100K range by just banking your cash into an index fund until you do have that, and then you can pull it out. So you get the growth from the index fund whilst you're saving your deposit, and then you can pull it out and buy a property with it. And then once you have a property, and you can keep banking that money into a portion of that money into an index fund that you're saving from your income into an index fund, or you could put it into your offset account, or you could split it up between both. And and then keep banking some into the index fund over time, and then keep banking some into an offset account. And then when you've got offset account is at a certain level for a deposit, then you can go away and use that to buy another property. It's the way I think about, like, then it expands with the compounding of like how, for example, if you just buy one property with 100K, in 3 years' time, it grows to, capital growth rate 5% for that 500K property, 25 grand over 3 years, 75 grand. You could take that money out of, like, all of that money out of, say, maybe your index fund. If you put it in the index fund, or it's equity, you can take that equity out of the property, and that property could buy you another property, right?
Yeah, or you could use it to buy another index fund.
Yeah,
as well.
Exactly.
So, as well.
But with
and
index fund,
that's a good
hard
point
to take
too,
that money out and then reinvest it. That's going to expand in that capacity, right?
Yeah, really good point, because like the downside of property is it's not liquid, right? So
Slow.
if you, like, where people do struggle is that they put everything into property, and it's like, okay, cool, well, we might be wanting to take the foot off the pedal a little bit, so they've got to sell a whole property, and then they got to realize all the capital gains, like when they might not need that 100 grand, they might just need 50, and that's the issue with it. And that's why I'm saying, like, I do like both strategies for that exact reason, where if you want that access to that 50K, you can sell down a more liquid asset, take the portion that you're required, live that, the lifestyle chips, take them off the table. That's kind of one thing that I do really like about it. And it's like everything; it's always case by case. But it's kind of like going back to what you said with there's just so many ways to skin this thing. And like, yes, index funds are a great way when you don't have a lot of initial capital to sort of grow value. I'd preface that with there's no guarantees. You don't just put money into an index fund and it goes up. I know the last 6 to 10 years have been very positive. Basically, since 2013, has been very you can't go wrong. Don't underestimate that it doesn't happen like that forever, and it never will. So that's where, this is a good point. I've got a friend that's like, oh, should I invest in shares to build my deposit up so I actually can get into a house? Because anything that I want to buy that's a house is, I need basically 200 grand. I don't have that. So what do I do? And then the conversation, and this is obviously not financial advice. I can't give that. It's just all general. Is like, if it was me in those shoes, you got to ask yourself those questions of the losing money is a far greater emotional impact on your mental health than winning money. So what's the bigger rock in the jar?
Not losing.
And then to build confidence too, you need to understand, like, this is why we're doing this podcast, right? Is like, we both love that sort of like the financial markets, looking at the future, and it gives you confidence to go, well, what is it that I do? Because a lot of people get into shares just like you and I did. I got heavy into it like when I got out of school, and then we finished school in 2005, and then GFC hit in 2008, and I was investing into shares because it was like that euphoria stage, and I learned a lot. But when your friends are talking about, your cab drivers talking, Uber driver talking about it, like everyone's, I've just put money in and I made it. Like, it was so easy. Then that's that trickle effect. And you're the retail person coming in the back end, the peak of the market. You're the emotional person that's not looking at the charts. That's where it's like, when you get into this investing game, don't just go throwing your money around because you've got it, because there's people on the back end there's a far greater game being played. And the deeper I get, like, I'm still learning too, like, people aren't playing 12 months games or 5 or 10 years games. They're playing like 50-year games, and even like looking into the next generation, and how they set that up. So that's why I say zoom out.
Yeah, I agree. Like, when we zoom out, like when you think, okay, somebody's listening to this podcast and like, all right, I'm going to start saving for a deposit and then put it into index funds. Well, like, zoom out to see what the macro economy is looking like. Where are we at in this 18.6 year market cycle? Like, I think it's actually a really good thing for my friend to now take his money out of his index fund to buy a property, because in the 18.6 year market cycle, like property market cycle, that is sort of like tied and linked to other markets. These other markets like crypto and index, like crypto and stocks, are going to be a lot more affected typically than property, which is the narrative and the true story that's happened for decades and decades and decades. So to take it over into property at this time is good, versus like starting from scratch and I wanted to chuck it all into index fund. Like, if you look at what happened in 2008, it's a scary thing for business and stocks when this 18.6 year market cycle ends. And I'm not going to tell you when it ends because I don't exactly know. But
no one knows, mate. There's theories and all that, and like, you just got to wait and see. But yeah, I'd say the 18.6 year, like, there's a lot of evidence behind that. And it's all a theory. Like, that's they're still with the property share market economics team. Like, they still say that if there is an anomaly like a world war, then that can throw the whole thing out. Like, you just don't know what the future holds. But if you zoom out to any go to your index fund charts, like, you don't see that level of intense growth over such a large period. Like, go on forever, and it's been going on, as I said, in Australia, probably 2012, 2013. If you look at those charts, so like that's over 10 years, 11 years. It's pretty interesting from that front. And there's different cycles. There's commodity cycles. There's a business cycle. There's the election cycle. Like, this is the game that you're sort of entering into and you're playing. So I think, there's just so much to cover.
We got a bit off track. We got to be excited, but coming back to index funds.
Well, go back to index funds. One thing that I'd say, like the dollar cost averaging method, everyone talks about that, like in the retire early kind of thing, fire movement. I'm on the camp of you can. That is more of a passive investor, and you'll outperform on that front because you're taking the emotion out. So it does suit a certain investor type. For me personally, I would rather take my time, be patient, and wait for those 20% drops before I put my money in, and they might happen every couple of years. It's just that patience. It's just deciding what kind of investor you are, and that comes from what kind of person you are and what life you want to live.
Yeah, and I mean the way you can do that, like for example, is say you save some money using an index fund to get your first deposit to buy a property, and then once you buy your first property, you could save your money into your offset account until you see those drops, right? And then go, I might take it out of my offset account, and the opportunity cost of me leaving it in the offset account against the property versus buying at a 20% dip in the market, you might get better returns on that money in the market for a shorter period of time, and then take it out and then buy a property or put it back into the offset account. So it's really the question that we're asking here is not just index funds or investing in property. It's how do you weigh up opportunity cost at all different levels with all different types of asset classes, and that's basically the mindset you really need to have when you're investing or building wealth.
Yeah, and with residential too, like you hit on this at the start, and it was a really, really good point. So circle back to that one is, property isn't just it's not typically not an investment vehicle, right? It's a shelter for people to owner occupiers dominate that market. They run around 75% or 70% of the loans done in Australia are for owner occupier, and then the 30% to 25% is investor. So it sits around that range. So it's a completely different sort of vehicle, and that's safety and shelter. And then that's like this rise of the buyer's agent side of things. If you get into an analytical buyer's agent who's understanding the fundamentals of the property market, that's how they outperform. And there's a lot more sort of like security around that, because for me, I'm always looking at risk. What if this thing ends? Because there's a lot more detrimental. Once again, I don't need to be that one that we got 25% return or 25% growth year on year. That's all cool, marketing team, but they're doing that to suck you in.
Yeah.
If you get 25% growth in a property in a year, you're in a really hot market, right? And that doesn't last forever. And also, this is something to consider too for those that are looking at buying in regional locations as well. The market's changing. Like, there's a lot of growth going forward to these regions, but it's a more volatile market. So, like, volatile compared to shares. Like, I'm talking like the investment time horizon has now gone from 10 years for buying property to 5 years. But I like to reassess everyone's every year just to sort of see where that's at, because you can outperform in those regions. You can also outperform in inner cities if you're actually really niching into it. You just got to sort of find what fits with your risk profile. But does that kind of make sense?
Yeah, absolutely, absolutely. I think we did good here, guys. If you think we did good as well, please let us know.
I'll preface this too, because there's going to be everyone's got an opinion, right? And yes, leverage is with property, right? So like there's risks in that. You put your 100 grand in, you leverage up to 500 grand, and you go in. If that property then drops back, let's be honest, it could drop back 5%, and then you're in basically negative equity territory on that front. So there's a risk there, and that's where you're just working with someone that does it. Like I go seriously into such a depth into tracking, supply and demand metrics and risks involved, and then I go into finding the best, locations within these local government areas, like best suburbs, best local government areas, and then best property type, and then looking at the price point too, because the government stimulate the lower price point market because there's a ripple effect, and they know if they stimulate that, then that helps to generate greater gross domestic product for the nation. It's been happening for decades, so don't go against that long-term trend, and that's where it's like you're reducing that risk. So when people say, well, you're using leverage, I'm like, yeah, I know, I'm doing it because I understand the risks. If you don't understand it, outsource it to someone who does, that like and trust. This and that goes with in what you do, mate. Like, anyone can go and buy a business. It's not hard to buy anything. It's hard to manage it and then know when to sell it as well.
Finding the right one is the hardest part.
Yeah, and like what you do too. Like, it's same. It's just there's just so much nuance towards it, and by doing it all the time, you're learning. Like, we're all learning. Even like some of the best investors, like old Buffett, like he's still learning. You know what I mean? So, and he's like nearly 100.
Yeah, yeah. Some people, like, if your goal is just investing shouldn't be just to make money. The first rule should be to not lose it. Like you said before, the emotion of losing money is way worse than the emotion of way stronger than the emotion of gaining money. And that's Warren Buffett's and most best investors' rules is don't lose the money. Because if you did just forget risk, you would just be like, let's just go buy all the businesses because there's infinite scalability in business. And then let's go buy crypto because the scalability is so much greater. But it's just Anyway, we don't need to get into that. I think we've gone backwards and forwards on opportunity costs, and just consider that when you're investing. And if you guys have any questions, reach out. hello@propertypals.au.
Yeah, hello@propertypals.au. The last final parting thing would be, it's a whole new world when you actually invest in something and then it doubles in value. You don't know what to do with it. And that's another thing, knowing when to sort of sell, what to get in, when to get out. There's a lot more to it. Like, it's a positive thing that you've made money, but then, like, as an example, I got my wife into, like, she trades stocks. Like, she's just sort of like getting involved in it because it's just, I think it's good for people to just put a little bit of money in, because even if it's like $50 or $500, you're still kind of like, you're emotionally connected and you're seeing how these things work. But she picked a stock that, it like doubled or tripled in value. And she's like, oh, do I sell out? What do I do? And I'm like, well, I didn't buy it. What was your thesis? What's your time frame? Are you holding it for 12 months so you don't pay capital gains tax at 100%? Or do you, was it, if it doubled, you sold out? Like, that's the strategy in any investing, is like going in with a plan, because otherwise you're just gambling.
Agreed. Thanks for listening, guys. See you in the next one.
Bye for now.